guys, which I'm not going to dive into too much on explaining an IUL. I think everybody in here understands for the most part what that is and how it can help our clients. Tonight, I'm going to spend some time just showing everybody how you can access an illustration, how you can play with the numbers. I do this in my spare time quite a bit, and I would like you guys to get familiar with doing that, because when you're with a client, it's nothing better than being able to pull up an illustration and show them the numbers. I think with an IUL, the most impressive part and beneficial part is when you see the value that you can create for yourself, 10, 20, 30, 40 years down the road. All right. So I'm going to share a screen here with you guys, and we'll get into it. All right. So there's two places that I generally go to do illustrations. I think every company that offers them will have their own software. And as of right now, Mutual of Omaha, Transamerica, American Amicable, they all offer a UL. All right. And so we'll do this from scratch here. So right now, if you guys can log into your Mutual of Omaha accounts, I'll kind of walk you through where you can find the WinFlex illustrator. So you'll want to go get logged in. Sales professional access here. You want to scroll down on your left-hand side. It's right underneath sales tools right here. It's that option that says WinFlex. You can get a basic easy solve quote, but for clients who want to maximize their returns, that won't be good enough. All right, so we'll hit WinFlex here, and you can hit visit WinFlex web. They used to have a desktop version, but hit visit WinFlex web here. If it's your first time, you're going to want to hit register for WinFlex. You'll be allowed to create a username, put in your first name, last name, company name. This is just your profile. So when you do illustrations, this information here will be what's listed on the actual illustration for the client. So right, company, I know with our final expense, we're used to premiums of, 1,000 or 2,000s a lot, but premiums with IULs, and it can get up there. There's generally, $1 million, $2 million limit annual premium with some of these companies. I think some of them even go up to 10 million a year. So we're in front of a different clientele when we're talking and going over products like this. All right. So don't be shocked. And that's kind of the people that we want to sit down and offer this product to. This is not something for really anybody who's on a fixed income per se, though we can with the amicable product, we can kind of give them something, but ideally we're looking for the self-employed young working professional. So we're going to want to hit shortcut here, hit illustrations. Like I said, you'll see your companies here, carrier. Sometimes they'll post little updates on each one. So if I click Transamerica, if there's any new updates or anything, it'll pop up here. There's nothing up there. Mutual of Omaha's got deferred income annuity, so on and so forth. So here you'll see some of the folks that have already been working on, but I'm going to run one here on Derek. We're going to do, let's look at Mutual of Omaha. So when you click on the company, it'll show you the products that are available. Now, Mutual of Omaha has a couple, right? They've got the Income Advantage IUL that I've written before, and the life protection. Those are fully underwritten, right? Fully underwritten only. I like doing the Indexed Universal Life Express because it's simplified issue, right? And it's the same underwriting as the Term Life Express. Now, they do go a little bit further in asking about the annual salary when you're going to take the application. So the client has to be qualified. And I think I explained it to somebody earlier this week that they're going to be checking some of these companies, the premium to income ratio, right? So if a client puts that their annual salary is 70,000 and then they're wanting to put in 40,000 a year, that might ping it for a red flag. So it has to make sense. But With Mutual of Omaha, they have the Index Universal Life Express that I think is one of the easiest ones to write. I don't think you have to be a pro at it in order to use this product or to get an illustration for anyone. So we're going to start here.
What's that Acuum UL Answers?
That's another fully underwritten. So they've got a couple different ones here. And I will say the difference between that and the indexed obviously is going to be the speed of issue. So Index Universal Express, we can get that issued just like anything else. You can get the approval on the spot sometimes, or it'll go to a review and it can be issued in under a week. The Acuum Income Advantage Life Protection, they're set up different ways. One can be like a GULE with minimal cash value, and these other two here can be income where you're turning on a stream, give you higher interest rates. There's different index crediting options, but to answer your question, it's just a different bucket that they're offering there. It's a different product.
Okay.
This one here, IUL Express, we want to hit that and hit create client down here. And we'll want to type in the client's name, Derek Locke. And Mr. Locke,
Yeah.
what's your...
Male, sir. P standing up.
Okay, and when's your birthday, sir?
May 30th, 1989.
All right. So you'll see here, guys, risk class, it can only be standard. All right, like I said, it's just like their whole life, just like their term life. It's not fully underwritten, so you can't get too fancy. So do you smoke, Mr. Locke?
No, sir.
Standard. We're going to want to change our state here to Florida. All right. Once that's typed in, we want to hit solve for. So this is where we're going to start building the illustration and start building a portfolio for this client. So as we already know, they have the easy solve option that kind of takes care of everything for you. The easy solve, I would say, is kind of offering a client a UL that won't build a whole lot of cash value, but it'll give them a larger death benefit. All right. For what we're talking about, we want it to where we're going to be able to get a dollar amount and maximize that dollar amount for returns. All right. So the option we want to hit for that is face solve. Right. We want to solve for the face amount is what that means. Premium solve means we have a face amount and we want to solve find out how much it would cost. So we're going to do face solve here. The face solve option that we're going to want to click on is minimum face amount. For example, let's say I've got a client that has $100,000, right? You can do a single premium lump sum with an IUL, but you don't want to, right? Because the premium for that first year is what's going to determine your death benefit. All right, so it's better to break it up. The best way to break up or to do a lump sum is actually break it up into equal payments for 5 years. All right, so if I've got a client with 100,000, we're going to put 20,000 in year one and each year for the next 5 years. Right? That's called front loading. All right, we don't want to put too much on year one and then there's nothing at all year two, because now that death benefit for year one already said that we put in 100 grand, so the death benefit could be in the millions. And if there's nothing going in year two, right, it can lose gas quickly. So we want to, anytime you have a client who's got a lump sum, we want to encourage them to let's break that up into 5 payments annually for 5 years. They can choose to let it ride after that if they want to, or put in something. I recommend, hey, just put $100 in, put something in those other years as well, just to keep it going. All right, so lump sums, we want to break it up into 5. But so back here with Mr. Locke, and normally what I ask him is, hey, Mr. Locke, as of right now, how much can you afford to set aside for your retirement or to set aside for savings?
$2,000 a month.
$2,000 a month. All right. Which for this product, guys, that's kind of high, especially at his age. But the good thing with this program is it'll kind of adjust it out for us. All right. So premium amount is $2,000. And what it'll do is it'll generate the minimum face amount that we can get for the $2,000 without having the IRS come into play for taxes. Your next option here is going to be disbursements. This is if the client wants to see money coming out back to them at a certain age. All right. So let's say we've got a client here who's 33, male. He wants to see, hey, at age 65, how much money, if I retire at age 65, how much money can I pull out annually, for the next 30 years or till I'm age 95. So we would fill that in here. For the sake of this illustration, I'm going to keep it simple and not do it. But if we ever have a client, that's what we would put in here. We'd put in the amount. We can do a loan or withdrawal to basis. If you do it as a loan, guys, that means that they're taking it out of really the cash value that's earned above the principal. All right. So when they take it out of withdrawal, that's just coming. That's, let's say, between now and age 65, Mr. Locke himself puts in $100,000 in premium. Withdrawal would be him taking out the money he's already put in, which is purely tax-free. Now, what happens with once he's fully exhausted that 100,000, now we move over to loan so that it can be tax-free as well, right? The government can't tax a loan, right? So we always want to make sure, which they'll either one of these are fine, but you want to pull from your withdrawal first generally, rather than just going straight to your loan amount, which is your interest. It'll be less here in the loan amount generally. Depends on what. Only if the client is like, really planning for retirement. What I show them is the actual account value, and then they can determine, well, okay, well, I've got $1 million here. I only want to take out 50,000 a year, or, that's fine. Some will be as needed, but I really focus on that amount. Some clients do ask me for that, hey, I would like to supplement my income with this policy at age 65. How much generally can I take out? So I would do that for them. Loan type, there's two different loans. Each company will vary. There's a standard and then there's an index. The index is going to be kind of like a variable if you were talking about getting a mortgage, right? Normally your index is going to be a little bit lower than the standard, but some of these companies, their standards already darn low. I think Mutual of Omaha, they're at like 2.75. Transamerica, they're around the same or less. And they'll tell you what the current interest rate is at that time when you run the illustration. Tax basis, I generally leave those all blank. Moving next to index strategy, this is the bucket that you want to put the clients allocate their funds to. So allocation is the funds above the premium, where we want that X. Index strategy, guys, and allocation is where we're going to be placing that excess premium, right? Obviously, we want to go where we're going to get our biggest return, but then there's also something called participation rate, which means how much the money that you allocate gets to participate in this interest rate, all right? And what Mutual of Omaha has set for you already is typically what's been their best or highest average, which is their 100% allocated annual point to point. So what they'll do is they'll place a point from today, and a year later, they'll go back and they'll see how much growth has happened from there. The cap for this product is 9.25%. And what the IRS is letting them illustrate based on their 25-year average is 5.87. All right. As far as what's offered in the industry, is that high and low? That's right in the middle. All right. So for example, Transamerica, we'll look at theirs in a second. They can show 7%. You are American Amicable, theirs is 2%. All right. Mutual of Omaha is right in the middle at that 5.87. So we're going to put 100% on here. The fixed account, let's say it's going to be.
I'm sorry. So the Mutual of Omaha, is that because this is the only reason? Because Transamerica, is that because the underwriting is harder to get? Is that why is that why the return is higher?
With Transamerica, yes.
Yeah. Okay.
So remember, I said Mutual, they have higher, right? But it's fully underwritten.
Gotcha.
So Mutual does have a product with a higher cap, but it's fully underwritten. Now, the market is the market, right? No matter what product they're in, if the market's trash, the market's trash. If the market is great, you're just going to get all the way up until that cap, right? So they get a higher cap. Generally, they want you to be a little bit more healthy, right? For this product, it's simplified issue. So the cap is just lower, 9.2. There's an uncapped earning here. So you'll see this one has no cap, but then the participation rate is 45%. Right. So this one, you can get up to the 19 and 20, then you're only going to get less than half of the credits. High participation account. This one's participating at 140%. So 1.4 on the multiple. The cap is 6.5. Why you would want that, in my opinion, I have no idea. 9.25 or the fixed account. That's always going to earn 2.75 with Mutual of Omaha. All right, so we're going to look at this illustration at the 100% year over year with a 9.25 cap. Policy options. Two ways you can do this. If the client wants a higher death benefit, you can put level. Sometimes it's better to do level. If it's a client that has a large premium and we're going to place the payments in for the first 5 years, we're going to want to hit level. Okay. Otherwise, we want the lowest death benefit possible. So we're going to want to hit increasing, which is option B. Right. It doesn't say it here, but that's an option B. So what'll happen is instead of it being 100,000 in all years or the first 30 years, this thing might start at 30,000 and then grow up to 100 and surpass it at some point. For a max funding, it might be a client is particular on having a certain amount, right? Let's say the client is like, well, I want higher death benefit than that. Why would they want that when we're trying to max fund it? That means they're not as cash minded, right? They're not as cash value minded. So they may want a higher death benefit with level. If it's something where we have to put in larger amounts of money in the first 5 years, then we want to put it to level just to keep the policy balanced. Otherwise, we're going to want to set it to increasing because that allows us to drop lower, right? That allows us to put a death benefit that's lower in the beginning and let it grow up rather than it being the same in all years. Because remember, when the higher the death benefit, right, the less wiggle room we have on a certain amount of premium. So Mr. Locke told me he's got $2,000. I need to get as low as I can here starting out. I'll show you guys the difference between running it at increasing and level. We might have to drop his for a client doing 2,000. Like I said, it'll adjust it for us, but we might want to take him on over to Transamerica if that was the case. But we want to put premium mode, VSPs monthly, quarterly, semi-annual, or annual. Again, the discounts still apply there. I generally, if the client can afford it, tell them to do level, especially if they're going to be doing large, 20,000 or 10,000. Might be better to do level to get a better rate. But we're going to do 2,000 a month here for Mr. Locke. The pour-in amount is kind of what you were talking about, Jamila. If you want to put a lump sum in there, they call it a pour-in amount. Transamerica, they just call it lump sum. Let's say the client already had a whole life policy or another kind of life insurance policy with cash value, and we want to roll over that amount tax-free, or certain types of annuities, we can roll it over, and that would be the 1035 rollover amount. That's a tax code. Years to print, we want to leave on max. Sometimes if the client only, or if you want to only show them a certain amount of years, you can hit years. Prevent MEC, that's to keep it from becoming a modified endowment contract. That's what MEC means. And a MEC is taxed for gains. We want it to not be taxed for gains. So they have it checked there already for us. Riders, it's up to you guys. I love that Mutual of Omaha includes the chronic illness and critical illness for cancer, stroke, and heart attack. So they make it super easy. There, they've got the optional paid up life insurance lapse guard. So they're going to give you a no lapse guarantee. Guaranteed insurability allows the clients to increase their policy later on. I do recommend, the disability rider. If the client ever gets disabled, it can waive the policy charges. Some of them, if they're healthy, it can continue the planned payment amount, which is huge, right? So let's say Mr. Locke wants to put in 2,000 and that's his max, right? But his actual premium payment should be $200. Continuing the ability for it to continue growing at the $2,000 amount is a lot better than them just waiving the $250, if that makes sense. All right. But either one is fine. Either one will keep the policy going as long as the disability continues. You can do accidental death on there. You can do child rider amount. we'll take the disability off of there. But I do recommend you guys running that. It can add an extra $2 or something like that. But if the client's disabled, if they're younger, how about offering them a plan that'll not only cover them for if they die, cover them for cancer, stroke, heart attack, terminal illness, confinement to a nursing home, and disability, right? If you're disabled, your plan will still stay in place. That to me, that checks off a lot of boxes for a lot of working professionals who have no life insurance, who have no disability policy, who have no retirement account. This will check off everything for them.
So what would you put in the premium amount? The 2,000 or the 200?
Yeah, we'd put his right. Oh, there we go. We put the two. I would put the 2,000. It'll probably throw this whole thing off because I don't think it's built for that kind of money. But let's just
if he was paying, so you wouldn't put what the minimum. You would put what he's paying a month, the 2,000 a month.
Because we want that. He wants that cash value, right? The waiver of policy charges. That's just for a client who just wants the coverage, right? Mr. Locke is buying this policy to accumulate growth, right? Cash growth. He's not getting it just to keep a policy, life insurance on him.
Gotcha.
If he was, we would build this different. This would be an easy solve, and then we would go with the waiver of policy charges. But my guy here wants the money, which a lot of people do. You'll get folks who have seen videos on YouTube. That's where generally I get a lot of mine, Instagram, and now everyone's interested. And there's a disclaimer that I tell them. I tell them, look, if you're just looking to get rich quick, then you need to talk to somebody else. We can't show you get rich quick with this policy. That's not what it's designed for, though. The internet will tell you that. But if you make your payments, if you've got the ability to compound interest on your time and you're young, you can get rich for sure with this type of policy. You can turn your money over 200, 300, 400, 500% in your lifetime. All right, reports. They give you your policy highlights. That's kind of where I leave. And then we want to hit calculate over here in the top right. If there's an issue, it'll pop up over here for errors. All right, so there's an error. And I'm guessing it's the disability and then the disability. These here, so it's telling us to have a higher face amount. That's because it's not built for really 2,000, but I'll take off the disability and it still should work fine. So to go back, we want to click on his name over here on the left. We'll go to riders, take off the disability rider. Go back, he'll calculate. If it does that again, then we'll just knock the price down and make it feasible for the program. Now, why they said that, guys, is because they have a max face amount for this product, which is $300,000. Him at $2,000 a month, it's determining that the IRS will want to see a higher face amount on the policy. But like I said, these generally run quicker during business hours. But I encourage you guys to, if you're able and if you can health qualify, look at running one on yourself just to get some practice in. They make it super simple. They have one of the easiest applications. So you see there, we took off the disability and it popped up here. So this is kind of the screen that you'll see next. It'll run ahead and give us an alert. And I know it's going to say that they want to see a greater amount than 300,000 in order for him to pay 2,000 every year. But what it did is it adjusted the premium intake annually in order to prevent it from becoming a violation. All right. So here his target premium is 2,000. Right. The initial premium is just under the 2,000 a month. So it's at 1,727 because the face amount max ended up being 300,000. All right, guaranteed years, which we love to see. This will generally let you know the strength of the illustration you ran is how many years of coverage can it guarantee him without any interest being applied. So it can guarantee him, looks like, coverage for 61 years, and he'll pay up until he's age 100. This is annually.
Oh, okay. I'm so sorry. Thank you.
No problem. So to see the illustration, you want to hit this PDF button here. And their illustration, I'll say, is it's a lot. It's packed in here, but they make it very simple to read and understand. All right, so it's saying at their max of 300,000, you can only put in 1,477, and that's going to be due to his age and health. So the older the client is, right, you still have that cost of insurance that's higher. But for somebody 33, the max they can do is $1,400 a month. There's the riders here. It's going to tell you your policy at a glance. His minimum no lapse will last to age 53. As we scroll down here further, we'll see where the guarantees will go, but his minimum loan lapse is generally a 20-year mark. For a lot of UL policies, you'll see that the good ones will give him a no lapse premium for 20 years. So as long as he makes his minimum payment, his coverage will last until he's age 53. And for you guys just learning, you want to read all of one of these. You want to do an illustration for yourself and read the whole thing, but you can highlight these blue boxes for the clients if they don't understand something. All right, this goes over the living death benefit here. Some of the things that they can.
So wait, so what happens after 53?
No, his policy's fine. It's just saying there's a minimum no lapse guarantee.
Okay.
So he's covered. And like I said, I'm going to show you down here lower what happens after age 53. But they're saying if he just pays his minimum premium, they can guarantee it won't lapse for 20 years. They're guaranteeing that. So this talks about index strategy, index crediting.
Now so was that the 1477? That was the maximum. Where was the minimum?
I'm scrolling down here to it, sweetheart.
Oh, okay. I'm sorry. So with all of that, will we be going over all of this with the client?
Yes, you want to tell them that. You want to tell them, hey, your initial premium, Mr. Locke, looks like they were not letting you do the 2000 there, but you can put in 1477 year one with the death benefit, as long as the death benefit's at 300. Remember, we put increasing, right? So as that death benefit grows, he can put in more. But at 300,000 at his age, he can only put in 1477. This shows the S&P annual return. So this is what the stock market actually did here in the last 20 years. This is what those index crediting options would have returned the client, right? And we chose the 1 year 100% participation option. So we look here, they've capped out quite a bit, right? And you never see, one of the benefits I said with an IUL is you never see it go negative. So the market was negative in 2002, negative by 23%. So if you held a 401k in the year 2022 or 2002, there's a good chance that you were 23% down or more, depending on how they allocated your account. Here, if you just had an IUL, you wouldn't have lost anything. You would have just broke even, right? So you never go negative. But here in the next year where it rebounded and it went 26, they just cap you out in 9.25, right? So if we're looking over the last 20 years, it looks like they hit the cap 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So 12 out of 20 years, they hit the cap of 9.25. And I tell the client, hey, you remember we only illustrated you at the 5.8, right? That's your average. But look, the last 3 years alone, they've capped out. So this talks about your minimum no lapse protection. 300,000, providing premiums of $1,172 are paid continuously. That'll keep his coverage in effect for the 20 years. So as long as he pays $1,200 a year, his coverage will last till he's aged to year 20. But he's putting in $17,000 in the first year, right? We're 16 times more than where he needs to be for the minimum no lapse. So let's say somebody wanted a 20-year term for $300,000 to compete with, right? We can look at offering something like this as an option that would also, get some cash value growth potentially based on the market.
Gotcha.
Right, as long as you continue to pay premiums as shown in the premium outlay column, the policy's death benefit is guaranteed through policy year 61, right? And he's age 33. So as long as he's paying that, or what was it, 1,700? Let me scroll back up here. 1,400. As long as he's paying his 1,477 and receives no interest, which we already saw their historical average. If all these things were zero for the next 61 years, his coverage would last until he's age 94. Right? So that's like running a GULE for somebody. Right? You pay $1,400 a month. Your coverage will last $300,000 death benefit with zero returns, which we know that's not going to happen till he's 94 years old. Right? And because we know that's not going to happen, this policy will most likely last forever till the day that he dies. We can't guarantee him that. We can only look at the historical average. But if we know history, this policy will last until the day that he dies. These go over disbursement options, which I kind of explain how you can withdraw money. The riders here. More explaining of riders. Which are required in order to settle and offer an IUL or a UL policy. They generally, you have to have an illustration accompanying the policy, and you'll see that when you're doing the application. It'll ask you if there's a signed policy or signed illustration attached, or if you showed it to them on the screen. So for this client, which I tend to do sometimes, is selling them over Zoom. I just show them, do a screen share with the client. All right. So when you get to this portion here, this kind of will show you the guaranteed, right? This is if we're doing zero. So their guaranteed interest rate is zero. Their midpoint is 2.95, which is generally half of what the IRS is letting them show at the 5.87. All right. So after 5 years, his guaranteed surrender value would be $45,000. His death benefit is already moved off the 300 to 350 at the minimum, at the guaranteed at zero. Here's the midpoint, and then here's the assumed at the 5.87. So assuming that he would get 5.87 average per year, which I tell him, look, we saw the last couple of years it did 9.25. This is being modest. I think the company's actual average Mutual of Omaha on their products is just over 8%. The non-guarantees would show that if just at the 5-year mark, his end of year surrender value is at 60,000 and his death benefit is at 365. Right. So this column here is your no lapse. Right. This is the guaranteed. And then this is what the market can do to your policy. This is just an illustrated rate. It's not saying the client will get 5.87.
Got you.
Based on our average, we can show you 5.87.
Okay.
But in all actuality, here, look, the last 3 years, we were throwing out 9.25. So based on guaranteed assumptions, right, we already said 61 years, so age 94, then coverage will cease. And then based on this midpoint here, it'll cover him to age 109. And then obviously we know the non-guaranteed, we go in and they're just going to wait for him to die.
Wait, let me ask you about this. Go over to the end of the year, end of policy year at age, and then the annualized premium outlay, that 4,503. So at age 43, he's going to be paying $12,000. Or can you explain that annualized premium outlay right there real quick?
Yeah, we're going to scroll down here. So this is how much premium is going in that year, right? Remember I said his premium amount that we're trying to do was actually a little too high for the death benefit. Remember, they have to stay in line with what the IRS will allow, right? So here, when we scroll down here, his premium outlay will jump around a little bit based on his death benefit and what they will allow. So we see that annual premium outlay. He said he had $2,000 a month with his 24,000, right? Year one, they let him do 1727. He gets a boost there in death benefit. They let him do 19, 17. And this is just based on illustrated 5.87, right? What we already know with an IUL at the end of every year that I have to send you, your ledger for the year. Mm-hmm. That'll actually let you know how much you can put in the following year. So this is just an illustration to get them started.
So he'll know in year 4, I'm only going to pay $3,000 this year.
Based on if we're just getting 5.87, right?
Oh,
but
gotcha.
That's a way to find out. And I have a policy myself. Every year they're going to send you that letter, let you know where you're at, and then you give them a call and say, well, hey, how much money can I put in this year? And they'll tell you exactly what you can put in. But this is just saying, hey, if you're only going to get 5.87 for the next couple of years, this is what we're looking at. right? So year 4, it drops down to 3,338. Then it pops back up to 12,525 a year. So annual premium outlay, guys, that's what the money is going in. And I love that Mutual, they put a subtotal here for you so that you can measure the investment, right? And like I tell my clients, this is not a get rich quick. Absolutely not. There's nothing on this. There's probably some things. If they're looking for get rich quick, they should just go play in the stock market. If they want to get rich for sure, safely, tax-free, right? Without the hassle of having to click and when to buy and when to sell. All right. In the first 10 years, Mr. Locke would have put in $125,000. On the guaranteed side, if he received nothing in interest, his accumulation value is, still pretty good. There's $99,000 in cash value. If he receives a non-guaranteed at just 5.87 average, his $125, which is paying for his insurance still, mind you, is worth $150 on the accumulation value and $148 on the surrender. And you see that death benefit here is no longer $300,000, right? That accumulation value gets added on to the $300. So he's got $450,000. You only get that when you choose option B. Option B, they give you the accumulation value and the death benefit. All right, so he's got $450,000 death benefit, but he's already made his money back on his policy, and now we're all green in just 10 years. Right? Age 53, he's saving for, now I tell clients, this is you saving for your retirement, and you got life insurance, and you got a disability, you got the living benefits. This here, 20 years, you've saved $250,000. All right? You're guaranteed if you didn't get anything, 196. But boom, look over here. Your accumulation value is 400,000. You turned your 250 into 400.
Let me ask you real quick. So if you surrender your policy,
Taxes coming for
at
you.
20, oh, okay. So how do you take the money out safely? For instance, if we have somebody that want to do 5-year, 10-year, and they want to take it out to flip houses, for instance, and they're at the non-guaranteed, right? And they're at the 150,000 at 10 years. They can't take that out, and it's gonna be.
But you said surrender.
I'm sorry, not surrender. So can they can't take? Can they take that whole $150,000 out?
Yes, ma'am.
With no taxes?
Not one tax.
And you'll still have.
This is how they would do that, okay? They'll take 125 from their basis, which from their withdrawal, and then they would take 25 as a loan.
What?
25, right?
That's
And
nice.
25.
That is decent.
Now,
So you still have that death benefit over there. All of that is still
still
there.
have that 300,000.
What? So wait, is that so the?
Well, that's
the
not 300. It'll be 450,000 at that point, right?
That's what I'm asking. Yeah.
But you took out 150. But
Oh, I see.
right,
So we're going to
I'm with
subtract
you.
it. Okay, that's still
Got you.
good. That's still
Yeah,
good.
that's great.
still good. So you take your 150, you go run an investment, put the money right back in.
Wait. So you can put that back. You can re-put it back in. So
Yeah,
wait. So
That's
would
the
you be
only way
taking
I would
from?
tell somebody to do it.
No, for this.
Do it as a banking. We're not taking money out at that age to just live off of. You can if you want to. You don't pay it back. So here's what happens. We take it out, we get a loan, right? Or we take it out in the form of a loan, and they put an interest rate of 2% on there. If we're earning 5.87, it's just going to wash it out.
Yep.
Right. So there would be no interest on it. So the cool thing is, as long as this is higher than your loan rate, it's a wash, right? That just means instead of us earning 5.87, we're going to earn 3.87 on the accumulation value at that age to just live off of. You can if you want to. You don't pay it back. So here's what happens. We take it out, we get a loan, right? Or we take it out in the form of a loan, and they put an interest rate of 2% on there. If we're earning 5.87, it's just going to wash it out.
Yep.
Right. So there would be no interest on it. So the cool thing is, as long as this is higher than your loan rate, it's a wash, right? That just means instead of us earning 5.87, we're going to earn 3.87 on the accumulation value, on what's left in the bucket, right? If we deplete the whole bucket and we don't put anything back, then we're starting from scratch. right? So that 3%, you're gonna get 3% on whatever went in that year that was left over above your cost of insurance.
So that's what you're saying. So you only going to pay back the 25 that you took back from the loan, and you're good with.
I'm paying back everything.
You're
paying a house. If I'm purchasing a house for 100, if I'm purchasing and rehabbing a house for 150 to sell for 300, right? I'm gonna take my 150 out, buy the house, flip it, sell. Now when I close, sell it for 300. It's gonna leave me like 275, right? I'm gonna stick 150 back in, and I'm gonna keep 125 for myself. I'm putting the 150 back in the policy, and I'm gonna keep 125,000 for myself, pay taxes on that. I'm taking the 150, right, as a loan from my policy. They can't tax me on that. So when I repay the money back, I'm not gonna get taxed on the 150 that I borrowed.
Oh, that's dope. Okay. All right, I'm with you.
Get taxed on my net profit, which is the 125. So yes, we're putting the money back in. This is my bank. This is my retirement. I don't need it. I don't need to make withdrawals like that yet at age 43. Unless, like I said, unless they need to. That's not the plan though. You want to accumulate and accumulate. Okay. So down here, further the death benefit. So you can see where we're going with this. So you can look at any age, right? So Mr. Locke at age 63, he'd have put in 375,000, but he's got 877,000 in cash, over $1 million in death benefit.
Damn.
And here's the cool thing now, right? So let's say that Mr. Locke is like, all right, you know what? I'm cool there, Ty. I'm done. I don't want to put in any more money. We can switch from option B, put it on level, and it'll keep this 177 here, right? Because remember, the older we get, the cost of insurance goes up. The higher the death benefit, the more money it takes in cash value to run the policy, right? Let's say we just want to stop it there, right? We don't want the death benefit to go up. We can switch now back to level if we would like. We switched it to increasing earlier on to get us to put as much money towards the cash value. But once this thing is up and running, you can switch it to level if you want. So if you heard anybody, you might meet some clients who's like, yeah, I've got a UL and I don't have to pay for it anymore, right? So what he's doing is he's taking that death benefit at 177, and his payments for the rest of his life are going to come out of this number. So this,
that's what I was thinking. Okay.
55, it's going to come out of that number.
But it's not going to go to the 500 because it's not. Well, yeah, because then it'll be, so that 877, if we go to 73, 10 more years, he'll be at.
If he chooses to keep making payments, right? Because you see now what interest does, right? So you see at a 10-year span, he's doubling his money when it took us 20 years to double the money the first time.
Wow.
So when people talk about generational wealth, this is how you do it. You get a UL at a young age and you live a long time.